Here. All right, this is the review for the exam one, so I'll put it up here. All right, so I'm going to, I'll give you the page number that I'm going to go to on this one here. So these are the problems that we're going to go over. So in the exam, you're going to see several multiple choice questions. There's 20 questions in the exam. Okay, so there'll be multiple choice. Let's see, there are 15 multiple choice and 5 problems. Oh, excuse me, 6 problems. I'm sorry, 6. That equals 21, but your grade will be out of 20 basically.
Okay.
So you get an extra 5 points on that.
Right.
So these will be 5 points each. So the multiple choice, and in the test, you're welcome to use your book. Just can't use another person.
Right.
So just, you can use a book, you can
Okay.
Google it, I don't care, you can look whatever. It is timed, it should be an hour, 20 minutes.
Hour and
And that's what you ask, so you'll have 2 hours to go through all of that. What I would focus on is the problems, because they're worth a little bit more. So take a look at those maybe first, if you can. If you can't, then just go through the multiple choice. And give yourself some time over here. There's a couple problems that are a little longer than others, so be aware of that. The point distribution maybe isn't where that also there too.
Okay.
You should just be aware of that.
Some of these problems are really long.
Yeah, they're not too bad in the exam. I actually shortened them pretty good. They're just journal
Good.
entries. They're pretty quick.
Okay, good.
So they're not terribly long. So they won't be too bad. Where in some of them, yeah, you can definitely have. All right, so that's PE 2-2A. That is on page 82. All right, 82. All right, so in this problem here, it asks us to prepare a journal entry for the purchase of office equipment on October 27th for $32,750, paying $65.50 in cash and the remainder on accounts. All right, so the thing to remember here is, and the reason we're not doing chapter 1, just so you're aware, in chapter 4, this is going to encompass the question that's in chapter 1.
Okay.
So
Great.
I have one problem for each question, but this one will encompass both
Right.
because it covered so much information in that.
Okay.
So, so the thing to remember is what are we getting in, and what are we paying, what's going out. So, first things first, we're getting in office equipment, right?
Right.
So it's October 27th. So we have October 27th, and we are getting office equipment. That's going to be our debit. So we're going to debit that to increase that. And then notes or bills payable, probably bills payable, and bills payable in cash. So my office equipment will be $32,750. And then my cash is, might need someone to help me out.
26,200.
26,200, okay. Now, remember that, thank you for that, that debits and credits must always balance. Just remember that. So when you double check that, make sure that happens there. And to remember to calculate that, just think of you're buying a house with down payment, that's what I'm getting as the house is worth, that's what I'm gonna pay in my mortgage. That's what you're thinking of it as a part of that, so. And they'll pay that down over time.
Okay.
All right, so that is that problem here. Questions on that one? That's PE 2-2A. The next one we're going to do is EX 3-7. That is on page 135. This one here, your prepaid insurance account had a balance of $7,000 at the beginning of the year. The account was debited. So what I recommend on this, if there's something similar to this, T accounts. Okay, so we're going to do prepaid insurance. I'm just going to start over here. I'll erase this here so we don't get confused on what's going on. Now remember, prepaid insurance is an asset because we haven't used it yet. Because I can go back to, let's say, Geico. I pay my 6 months in advance and go, you know what? I don't want to use you guys anymore. I'm going to go State Farm or whoever. And I can take that money and then put it towards the other company. So I have not used it yet, so it's an asset to me. So this asset, until I use it, let's see here. So we had 7,000 at the beginning here. So we have 7,000. Remember that is an asset, so therefore our balance is a debit balance. Okay? And then we have, the account was debited with 24,000 in premiums. The policy purchased during the year. So we have 24,000 that we added to that. So as you can see, we have 31,000 total. And journalize the entries required under each of the following alternatives to determine the amount of the adjustments. All right, so the amount of unexpired is 8,500. So I have to then credit some. So how much would that be? So 31,000 minus that, which is 20, 22, 50, 50?
22.
Yeah, 2250, okay.
Need my tip key.
Yes.
I don't know how to add without it.
So we take away from that, so no, that's gonna be a credit. So that's 22,500. All right. So I'm gonna have insurance expense that we used. I'll give you a moment to keep that down. The last part of that question, just to be specific. Just trying to figure something out here. All right, so that's that journal entry for the first part there. So it'd be the amount of insurance expired during the year is 22,500. That would be the same journal entry, actually. So it's basically the same thing. It's
What was
expired.
that? I didn't.
It's the same journal entry. So the answer for B is the same as A. It's
Oh,
the same
okay.
exact thing.
Okay.
That's what's expired there is that much. That's
Oh,
what we use.
okay,
And that's
okay.
pretty simple. It's really tricky on that question there. So, questions on that one? All right, what I'm gonna do here is I'm gonna bring up a spreadsheet real quick to do the next one. The spreadsheet looks pretty nice in the fact that it give us, in fact, it should be actually in our canvas there for us. I think I left it on there. You may have seen some spreadsheets at the bottom. You guys see any of those there? There's nothing in there. I'm trying to know if I put any in. Usually do. Check here. Six dash 362. Okay. There it is. This I'll just pull up. have a computer, it's also, probably bring this up if you want to, I can email it to you. I'll put this on Canvas so that you can redo this.
Okay.
So we're gonna go through it together here, but, I'll give you a chance to kind of take a look at that, unless it pulls up right now. Make the adjustment on the camera here.
Should we go into a module or?
I don't, you want me to bring it up for you? Yeah, let me put it on there
Oh,
for you.
okay, great.
I want to bring it up there. I will blow that up so you can actually see it a little better. Have something right there. All right, so in here, this is a sample problem that we're going to do here. This walks through basically all the statements. We're only going to do the first portions of this. We're not going to do all of it because you're not going to be testing on all of it, but if you want to, you can. We'll only go through the first three parts of the problem here. So this is on page 200.
So is this question PR 4-1?
Yes. Should be. Let me make sure everything lines up there. Is that light? Yep, it is. Okay, good. This is on page 200. All right, so I'm going to blow that up pretty big so we can put some stuff in there. All right, so we'll read through the problem here. And one of the things we want to make sure everybody understands is what goes first and how it all goes. I know I put some stuff in there, some videos. Everything starts with the income statement. We'll start with that, moves to retained earnings, and then what a balance sheet. That's what the three things we're going to work on in this problem here. That covers chapter 1's question will be more on the income statement. This one will be retained earnings and possibly a little bit of balance sheet for the problem for chapter 4. So that kind of hits all of those. All right, so revenues. So we're going to go down to all where it says revenues there. You'll see that there's two things there. It's just under dividends. It's in 23. It says fees earned, and it says rent revenue. And what we're going to use here is we're going to use the adjusted balance after the adjustments have been made. Put those in there. So it's 375 and 1300. All right. Fees revenue, was it called? Okay, that's good. That's good there. And then rent revenue. Now, I'm going to make a mistake on this real quick here, so you can see something here. You'll see a star come up if you make a mistake on the spreadsheet. So it'll give you a star and goes, this is not right. This here is something different. It gives you a little note. It tells you something about it to help you as a hint. But this will give you a star here when it's wrong.
On the exam?
No, on this
Oh,
template
okay.
spreadsheet.
I'm like,
So when you do the
oh.
practice, if you walk yourself
Right.
through it, you
Okay.
go, oh, wait a minute, this is not right.
Okay.
So you'll know how to make those adjustments instead of just going, I think it's right. So it's supposed to be 1,300. And so I'm going to total these up. I'm going to use formulas on mine. All right. Now this is where it gets a little tricky in here, and hopefully it follows. Sometimes it doesn't. You have to put in exactly. And Cengage allows you to, it doesn't matter what the expense order is too much. Here it's very picky.
It wants to do descending.
Yeah, it wants to write
miscellaneous at the
exactly,
bottom.
yeah. So hopefully it's just going to follow all of these. We'll see how that works. So let's do that real quick here. So I'm going to start with the salaries and wages expense. Let's see. So far so good. Advertising expense. Then utilities. Can you see that in the back okay?
Yep.
Okay, good. Depreciation for the building first, then we're going to repair it. Oops, I like that one. Oh, I hit equipment's in the building. There we go. Repairs, expense, and depreciation. Equipment. I'll put the numbers in here in just a moment after I go through all this here. Supplies.
Wish we would have had a pull down instead of typing it all out.
Yeah, it does make it a lot easier.
Yeah.
All right, so this is what it's asking us to enter the amounts here. I'm going to again take the adjusted trial balance on that, so you can see it's 168,000. So you can do all the formulas and everything. It makes it a lot easier than having to do that. So there's your net income, net loss. So remember that when we're doing the revenues, take all the revenues you have, take away all your expenses. That will give you your net income or net loss. Hopefully it's income. All right, questions so far? All right, so next thing we have then is our statement of retained earnings. Remember our statement of retained earnings, we start with what we had at the beginning of the year, which it gives you in the book. So, to that, he tells us that we have 128,100. And that is on line 21. All right. After you do that, the thing you have to then add, you're going to add in your net income, then you take away your dividends. So remember statement of retained earnings, beginning balance. So this is probably the simplest one, but remember beginning, add income, take away dividends, and then you'll have your increase or decrease in your retained earnings. So I'm going to add my net income, which is up above here, which equals that. And then I will take away my dividends, less dividends. And they told us our dividends were $10,000. I think this one's in the negative, but we'll see how it wants it. Yeah, it just wants 10,000 actually. Okay, with the less sign made of that. So it's 130,000 is my increase. So I'm going to add those two together. All right, it's all tying together, I hope. So remember that this ties into that. That's why we need this done first, because that feeds right into here. And then we're going to take this number, and that's what goes into the balance sheet. That feeds right into
And
that balance
common
sheet.
stock always goes on the balance sheet, not on.
Yes, always on. Yes, yeah.
Because that's one confusing thing sometimes.
Yeah, just think of the common stock as my ownership in the building or property or the company, basically my company, what that is. So, and one of the things that you do on this here is you get rid of the closing statements, although I'm not testing you on it, you get rid of all this because we want to start over every month to see how we're doing.
Right.
And the balance sheet is always what we have overall. All right, so let's do the balance sheet then. So this is our number here. We'll leave that for a minute and we'll do that over here in the owner's equity. So let's do our current assets. We're going to start just at the top. We do most liquid first, which is cash. Liquidity meaning that we can turn that into cash. Cash is just the turn into cash. Then accounts receivable. And then we have prepaid insurance. I'm just going right down the list they give us. We have prepaid insurance is $1,200. These are my adjustments to some of the things we paid. And then next is the supplies. Now remember that supplies and supplies expense are two different things. Supplies is a asset until we use it, because we can always take back all that paper I bought from Staples, wherever I bought it from, and return that. Until I use it, then I use it, and I can't, and therefore I do the expense at that point. So. All right, plant, property, and equipment. We'll go to the next thing, which is the building. So I have the building here, then I have the accumulated depreciation of the building. Doesn't look like it's specified here. Oops. Let's do something to my building. Yeah, that's why. Then my building. It's totally wrong. Catch me if I'm not too far down. I skipped something on here. All right, so we have have equipment and then accumulated depreciation of equipment too. All right, so my land, remember we can't depreciate dirt. So that's one thing that we do there. Always set up videos, I'm sure. All right, so in the building here, I have 400,000. Over time, over time we depreciate that over time, so our book value shows something less. So that's the depreciation that we've taken. We look there, we have 215,400 that we've depreciated so far. And that gives me a total book value of somewhere about 184,600 probably. There you go. And then I have 101,000 for equipment. My depreciation is 91,780. So I don't have much left in this one to depreciate. We'll talk more about
I didn't know you
depreciation.
couldn't depreciate land.
What's that?
I didn't know you could depreciate land.
Yeah, you can't depreciate land just because it's dirt, it's gonna be dirt, it's gonna be dirt forever. So,
Huh.
just think of it that way, that dirt doesn't really change, so you can't.
You can't depreciate.
So where a building will depreciate over time.
Right. That makes
dirt-
sense.
Yeah, so that's the reasons. And really, depreciation is primarily for a tax benefit. And we'll talk about depreciation a little bit later, a little deeper and stuff.
Right.
So that's probably where I say it a lot more is actually the depreciation board. Yes?
Midterm review?
Yeah, come on in.
Yeah?
Yeah.
Okay. We were sitting over there for like another 20.
Oh,
25
I'm
minutes.
sorry.
That's all right.
I forgot to walk. Yeah, we're scheduled over there, but I thought I'd just come over here because it's a little easier. I'm sorry. I am taping it right now behind you, so you can catch up to what's stuff that we need, guys. That's okay. So right now we're on 41A. That's what we're working on right now. And this is, we're going over an income statement, retained earnings statement, and a balance sheet. So. Are you the only two over there?
There was one, she left. Whatever.
All right, so again, these are all the assets here that we have. These are depreciation, we don't depreciate land. This is what the book value says that we have on the books of that. So if we sell something then, theoretically, we sell it for 400,000, so we think we break even. But since we depreciated that, we show capital gains on that. Because we've taken the tax benefit of that over the time, and so therefore, we then have to pay the capital gains on that. So that's one of the things you have to be aware of as a part of that, so that would be a difference in that. And sometimes buildings obviously may go up, like our houses have been going up lately. So, but if we rented it out and depreciated all that, that changes our book value of what our basis is for that. So we have to pay that capital gains in between. Unless you live in, move back in the house for 2 years, another 5, then you're okay. That's for a whole other class.
Right.
All right, so I'm gonna go over the current liabilities. I'm on page 200. Right here, so that's what we're working on right now. I'm on the liabilities, or we're on the liabilities of the balance sheet right now on this one here. All right, so the liabilities here. So we only have a few liabilities here. We have accounts payable, salaries and wages payable. And are we good over here? I can slide this over so we can see everything. Over here. And then finally I have unearned rent. Now remember, unearned rent is a liability because somebody has paid us in advance for rent. And they have not used that up. So theoretically, since they're not in the lease, they can get their money back because they haven't lived in our place or whatever it may be.
So some of those questions were weird on the homework on how they did that. So they're saying that if they refunded it or they had,
if they're refunding some of the stuff they purchased.
Right, well, there was money in the liability and, so if they pay it back, then it goes into the asset part of it and reduces there in the liability?
So as time expires, so let's take an example of that real quick here. So as time expires, let's say I paid, I'm renting a storage unit for 3 months.
Okay.
So, but I have to pay 3 months in advance. And so I'm gonna pay $300. So $300, so it's $100 a month. So, right, so this is unearned rent to them. It's unearned, rented. So this is unearned rent to them.
Okay,
But after, so this is January 1st, when I pay this, so I have it through March 31st.
okay,
So on February 1st, I have used up 100 of this. So the journal entry would be then, maybe rent revenue, or unearned rents, we're going to do this first. That's right, unearned rent. And then we have rent revenue.
so you don't recognize it until, okay.
Till it's actually, and then we do
Okay.
$100 and $100. So now that would drop
That
down
would
to
come,
200.
okay, now I get it.
Yeah.
Okay.
So we do, so when you get this money here, you have a cash you get in as an asset and you get a liability until we use that. And
So you
usually
don't
the
want to
example I
claim it
give-
as, you don't want to claim it as revenue because it's not revenue yet.
Yes, because I
That's
haven't
what
earned it
you're
yet.
doing.
So usually my example for this is, I'm a landscaper, and somebody pays me, I'm gonna do a $20,000 job, and they pay me $10,000 up front as the deposit for that. I haven't earned it yet.
Right.
So that's until I have earned it, then that's when I actually take that. And then they pay me the last $10,000 at the end of the project, and that's when they finish, I take that in too,
Okay.
as a part of that. So it's when you earn that, so they think of it as that.
Okay. Thank you.
All right, so my accounts payable is 15,700. Salaries and wages, 4,900. Unearned rents, 800. All right, so it gives me a total there in my liabilities. Those of you, I'm gonna put this spreadsheet out there for you guys to take a look at, so you can walk yourself through the same problem. If they have a star by it, that means it's not correct. So that's one way to identify that it's not right, so just make the adjustments to that. And if you put the wrong thing in here, it'll tell you the same thing too. Obviously, you can figure it out because there's so many drop downs you can do. So, but I'll give you this spreadsheet here, so you have that. Drop it on the canvas. All right, stockholders' equity. So I have moved myself all the way down. Now I'm going to go to common stock. So I'm just under rent. So I'm on line 20. So common stock here. Remember that goes in the equity section there, and then I have my retained earnings. So common stock is my rights to whatever we've sold as a part of the company. That's what you got to think of it as. So basically, stock that you buy for Apple, Google, Sony, whatever it may be, some company. That's the common stock as part of it. Retained earnings is our earnings that we retain over time, how much money we made. We pay out some of that in dividends, but that's how much we roll over as a part of that. We've made in earnings over that amount of time. So that's what that is there. So that number of retained earnings goes back to that up above when we calculated it. So let's first put the common stock in, give us the value from the common stock, which is 75,000. So that's 7,500, and there's the star. Right, no written. And then here, retained earnings is right here. All right. So obviously these two need to add up to equal